Hey guys, Evans here. So today we will discuss a topic that many consider a mystery, but in reality it's just an understanding of the price movement. This is the liquidity zone and the hunt for stops. If you've ever noticed that you placed a trade in the right direction, but the price first hit your stop and only then moved to where you expected, it means you've encountered a liquidity zone. Many beginners think that the market is against them, but in fact, the market moves where there are other traders' stops. That's liquidity. In this video, I will explain simply where the market makers search for liquidity, why they always stop right before moving, how to find these points in advance, and how to prepare them for your entry points. I will show all of this in the quick trading mode. I want to focus on what liquidity is in simple words. Let's go. Okay, so liquidity is places on the chart where there are many open orders, that is pending orders, market entries, and the price moves to where these orders can be gathered. Who is a market maker and why do they gather stops? A market maker is a large player providing price movement. So to move the price, they need volume. And where to get this volume? Where there are stops of beginners. So the logic is simple. First, the market goes to where the stops are, gathers liquidity, and only then moves in the actual direction. An experienced player understands this, sees it on the chart, and you also need to understand where most of these zones are. So liquidity zones almost always form above resistance levels. Again, you can see resistance here. It reaches its peak, then a small correction begins. Here there's like a sharp move, a false breakout. The trend is clearly upward right here, and I think at least it will return to this zone and then go further up. But this is a resistance level right here. Exactly here, there are buy stops. So as per textbook, on the local maxima and minima where stops are placed beyond the trend line, this is how the crowd tries to place protection, and the market makers know this, okay? So as a result, a fake breakout occurs. The price suddenly breaks off the level and immediately returns. Again, now there's correction. So it will likely reach these numbers. Right here, this is a false breakout because the price did not go any further. This is not a trend direction, okay? It's very important to understand this. So by understanding all these things, you can identify the strongest entry points. This is very important. Again, there are three types of liquidity: above and below the levels. The most obvious, of course, is where the most stops are. That is where resistance or support levels are. And the third level is when the price stays in the sideways range in a so-called consolidation. Most traders place stops beyond the borderline. Okay, so right here, it's important to understand how the chart behaves. So when the candles are large, people chase the move but set a short stop. Market makers use this to their advantage to continue the movement. How to use these liquidity zones for trading. It's important to find a support or resistance level. Let's look at this currency pair as an example. We choose the 1 minute time frame. And if you're planning to trade on the 1 minute, you must use the respective chart. It's clear that the hourly trend is overall, but for a more impulsive entry, a smaller time frame is better, maintaining the overall trend. Let's mark our horizontal levels. The resistance here, and the support here. Okay, so in this case, you just need to wait for an impulse beyond a level. This is called a stop hunting. Then wait for the price to return and enter in the direction of the reversal. So it's clear here that the level was reached and now the price is gradually going down. So I'll try to open an order on another pair, but you should understand that testing liquidity, well, this process is not really that quick. It's important to understand this. In trading, rushing is the enemy. I won't stop repeating that you need to stay calm, keep a cool head, and not do things randomly, okay? That's why I don't overload each video with detailed information, but focus more on general concepts, because we will repeatedly revisit all of these points later in all of my videos, okay? So again, liquidity zones, mark them, understand support and resistance levels at first, okay? Here's an area where most stops are located, and experienced traders buy when the market turns around and moves in their direction. This is a crucial moment. It will break out further. This is obvious. And this is where many traders stop here. Large players are just starting to act, so the price moves based on their movements. So they wait for the right moment, they understand the brains behind this, and this is similar to analyzing behavior. Concepts of false breakouts, sharp moves beyond levels, then quick returns. An experienced trader understands this and doesn't follow the trend blindly. They understand the price will return and they need to enter later. This is very important because many see the ladder pattern, like right here, prices go down and then it reverses sharply upwards. So that's a false breakout. The long candles like taps the stop and closes back in the opposite direction. And as you can see, the result was in good profit. So again, we have identified the impulse, the resistance zone. It's just usual analysis. And there are three types of liquidity. Again, above and below levels, and the most obvious being where the crowd stops are. So during consolidation, stops are placed beyond the edges of the range. And when the price breaks above after like a little impulse, it leaves the sideways zone. This is a very key moment, okay? So liquidity on impulses is similar. Large candles, traders chase the move, but set a short stop. Market makers understand this and use this to their advantage to continue the movement. So roughly speaking, their actions influence the direction. This leads to a more strategic approach. Understanding liquidity zones involves identifying support and resistance, waiting for impulse beyond the levels like right here, then entering once the impulse occurs. Of course, I highly recommend don't open multiple orders one after another. Just a few successful trades per day are enough. Wait for the price to return and enter in the direction of the false breakout. If it's a false breakout downward, you buy. If upward, you sell. That's testing liquidity. So we will revisit this concept repeatedly. To conclude this video, I want to say that liquidity zones move the market. Markets are not chaotic. All you see on the chart is not random actions. The market goes where the stops are resting. So if you learn to see and understand levels, false breakouts, long shadows, impulses beyond levels, as we did in this example, you can identify where professionals are entering. Your goal is to enter where the pros are. It's also important to identify liquidity zones across different time frames. Always mark levels and understand the trend. Only by combining all of these factors can you achieve consistent results. I wish you successful trading. Hope you found something useful in this video. We will definitely return to liquidity zones and look at them more in detail. I wish you successful trading and look forward to seeing you in my next videos. Bye guys.